In October 2025, Nokia decided to issue 166,389,351 new shares to NVIDIA for a $1 billion equity investment, and use that deal to deepen a partnership around AI/RAN infrastructure. It delivered immediate cash and credibility, but it also created dilution and a growing platform dependence. This story begins with pressure inside Nokia's mobile business, a lower profit outlook in 2025, and a belief that the next spending cycle would be tied to AI. From there, it moves through the share issuance itself, the reasons it looked practical at the time, the slower costs that emerged as Nokia tied more of its Layer 1 RAN software to NVIDIA systems, and the point where ownership and technical testing made the relationship much harder to unwind. Before the NVIDIA deal, Nokia was already moving along a different hardware path. Back in November 2022, it extended a collaboration with Marvell to push forward its ReefShark chipset portfolio, including work on a new Octeon 10 data processing unit built on 5-nanometer technology. That matters because custom silicon means chips built for a specific task, and Nokia had been using that route as a way to improve efficiency and performance inside its radio products. By fiscal 2025, mobile networks still produced €7.8 billion in net sales, yet the segment operating margin sat at only 2.8%. The business was large, but not especially forgiving when pressure started to build. That pressure became much clearer in July 2025. Nokia cut its full-year comparable operating profit outlook to a range of €1.6 billion to €2.1 billion, down from the earlier range of €1.9 billion to €2.4 billion, and that revision changed the tone around the company's near-term position. Around the same time, Chief Executive Officer Justin Hotard said connectivity was becoming a critical differentiator in the artificial intelligence supercycle, which gave investors a pretty direct view of where management thought the next major opening would be. The company also said a weaker US dollar had created a roughly €230 million negative impact versus start-of-year expectations, while tariffs were expected to reduce operating profit by another €50 million to €80 million. More stories like this. Subscribe. By that point, the pressure was not just technical. It had become financial and strategic at the same time, which made the next move easier to understand. Nokia's 2025 annual report said the company generated €2.4 billion in orders from artificial intelligence and cloud customers during the year, and that number showed there was real demand outside the traditional telecom cycle. The same report also said Nokia's model was to focus innovation where it differentiated and work with best-of-breed leaders elsewhere, which meant management already had an internal framework for relying on outside technology. October did not create that belief. October turned it into a transaction. On October 28, 2025, Nokia's board resolved to issue 166,389,351 new shares in a directed share issuance, so NVIDIA could make a $1 billion equity investment at $6.01 per share. And Nokia said the result would make NVIDIA a 2.90% shareholder. That was the decision. The structure of the transaction mattered, because this was not a rushed response to bad headlines. Nokia said the board acted under an authorization granted by shareholders at the annual general meeting on April 29, 2025, and it valued the effective capital contribution at $1 billion or €0.86 billion, using the European Central Bank reference rate from October 27, 2025. Nokia also said the proceeds would be used to accelerate strategic plans around trusted connectivity for the AI era and for general corporate purposes, which meant the money had a stated role from the start. This was a capital raise, but it also worked as a signal about where Nokia wanted to place its next big bet. The structure mattered. Here is what we need to notice next. Nokia did not present NVIDIA's money as passive funding sitting on the balance sheet. It said the company would accelerate development of its 5G and 6G Layer 1 RAN software on NVIDIA's architecture, and that made the transaction sound tied directly to product execution. A radio access network, RAN, is the part of a mobile network that connects phones and other devices to cell sites, so this was about the core of the telecom system, rather than a side project. NVIDIA. Chief Executive Officer Jensen Huang said the partnership would add NVIDIA-powered commercial-grade AIRAN products to Nokia's RAN portfolio, and Nokia's own partnership summary pointed to the Arc Aerial RAN computer as a 6G-ready telecommunications computing platform. Product execution was central. The case widened when Nokia described where else the partnership could lead. It said the company would invest to increase its presence in the AI and cloud market, with data center-aligned networking solutions inside its network infrastructure business, which meant the relationship was not limited to mobile Layer 1 RAN software. Nokia also said the two companies would collaborate on AI networking solutions and explore putting Nokia's data center switching and optical technologies into NVIDIA's future AI infrastructure architecture. By then, Nokia had already reported 2.4 billion euros in AI and cloud orders during 2025, so management could point to a market that looked real, large, and connected to the same partner writing the check. The deal also has broader implications for Open RAN standards, where Nokia's AIRAN approach could influence industry architecture decisions. The cash itself mattered right away. Nokia's annual report said the decrease in cash and cash equivalents in 2025 was partially offset by 859 million euros from the issuance of shares to NVIDIA, and that gave the deal an immediate balance sheet effect rather than a purely symbolic one. Put in plain English, the equity injection helped stabilize a year in which Nokia had already cut its operating profit outlook, absorbed a roughly 230 million euros currency hit, and expected tariffs to reduce profit by another 50 million euros to 80 million euros. For a low-margin mobile networks business with a pressured outlook, an outside capital partner was easier to justify than it would have been in a more comfortable year. There was also a speed advantage in the way the market read the announcement. Nokia said the proceeds would help accelerate its strategic plans, while NVIDIA described the partnership as a way to pioneer the AI platform for 6G and place NVIDIA-powered AIRAN products inside Nokia's portfolio, which gave the story both a financial and a technical frame on the same day. Nokia's public summary added one more piece of credibility by naming T-Mobile US as a carrier working with Nokia and NVIDIA to integrate AIRAN technologies into its 6G development process. The announcement also noted Dell Technologies as a server partner supporting the infrastructure rollout. Reuters reported that Nokia's shares rose nearly 21% on the announcement day and reached their highest level in almost a decade, so investors reacted before operators had fully tested the platform. When we step back and look at the structure, the appeal becomes easier to see. Nokia was not simply taking money from a financial backer that wanted a small stake and no operational role. It was bringing in the company whose computing platform could help shape the next phase of telecom infrastructure, and that fit with Nokia's own annual report language about focusing internal innovation where it differentiated, and relying on best-of-breed leaders elsewhere. Hotard's July 2025 message about connectivity as a critical differentiator in the AI supercycle lined up neatly with the October plan to accelerate 5G and 6G software on NVIDIA systems. The deal let management move faster and told the market Nokia wanted to be part of AI infrastructure, not just a supplier of older telecom hardware. This approach contrasted sharply with competitors like Ericsson, which maintained a strategy of keeping their RAN stack portable across multiple hardware platforms, rather than designing specifically for one vendor's architecture. By this point, the original logic still held together. Nokia had generated 2.4 billion euros in AI and cloud orders in 2025, and the NVIDIA share issuance added 859 million euros that partially offset the year's decline in cash and cash equivalents, which meant the company gained money, a major platform partner, and a public AI-RAN association all at once. Nokia's October statement tied the proceeds to faster development and broader AI and cloud networking ambitions, so management could argue that the transaction supported short-term balance sheet needs while also helping with longer-term positioning. Meanwhile, SoftBank's ATRA's testing in Japan showed another major carrier validating the AI-RAN concept. The problem was not the initial reasoning. The problem was what ownership started to change. The terms reinforced that this was a firm commitment rather than a loose commercial arrangement that could be adjusted later. Nokia did not announce a future option, a soft memorandum, or a vague plan to cooperate. It set the subscription price at $6.01 per share, issued 166,389,351 new shares, and said NVIDIA would become a 2.90% shareholder, while the board could move because the authorization from the April 2025 annual general meeting was already in place. Nokia also translated the contribution into about 0.86 billion euros using a stated exchange rate, and that mix of fixed pricing, prior approval, and public rationale lowered uncertainty around execution. For investors, it looked concrete. The operating story made the decision even easier to defend in the moment. Nokia was not talking only about a future 6G vision with no product bridge in sight. It said the company would accelerate 5G and 6G Layer 1 RAN software on NVIDIA architecture, pointed to the ARC aerial RAN computer as a specific platform, and named T-Mobile US as a collaborator in integrating AI-RAN technologies into 6G development. When a company under margin pressure can point to a real computing platform, a named operator, and a clear source of capital on the same day, the case almost builds itself. Completion came 2 weeks later. By 2026, NVIDIA's stake of about 2.90% was already in place, and Nokia's total share count had risen to 5,742,239,696. That detail matters because it changed the relationship from a shared roadmap into a capital structure commitment. And once a partner sits on the shareholder register, the deal begins to carry a different kind of weight. From there, the story starts to change. Now the numbers begin to change the meaning of the decision. The first direct cost was dilution, because Nokia said the directed share issuance was completed on November 13, 2025, and that the new shares represented about 2.90% of the total after registration. Yet the deeper issue showed up in later industry reporting, not in the announcement itself. In March 2026, Light Reading reported that the NVIDIA investment broke with Nokia's earlier strategy of putting radio access network compute, RAN compute, on custom silicon and made prior investment with Marvell harder to justify. That matters because the Marvell collaboration had already been extended in November 2022 to advance ReefShark and a new Octeon 10 data processing unit, which meant Nokia now had two hardware stories pointing in different directions. Nokia's own position, as described by Light Reading, showed where the tension sat. The company's chief technology officer said Nokia had decided not to stay locked into custom silicon and described the NVIDIA deal as an expansion that allowed Nokia to have custom silicon alongside NVIDIA graphics processing units, or GPUs. On the surface, that sounds flexible and even prudent, because it suggests optionality rather than dependence. In practice, it means maintaining more than one compute logic at the same time, and that is a very different thing. A company that had earlier framed custom silicon as part of its efficiency play was now saying it would run that path in parallel with an NVIDIA GPU route. That overlap matters much more when margins are already thin. Light Reading reported that knowledgeable sources viewed it as unlikely. Nokia would have much, if anything, to do with Marvell for 6G, and the same reporting said that keeping 2 radio access network development tracks would come at some cost. That cost was not described as a one-time charge that could simply be absorbed and forgotten. It pointed to an ongoing burden of carrying 2 directions at once, while Mobile Networks, Nokia's core radio business, had posted only a 2.8% operating margin in fiscal 2025. A thin margin business can absorb a large strategic move once. It has a harder time carrying parallel technical commitments year after year. The dependence also moved deeper than ownership and headlines. On March 17, 2026, Light Reading reported that Nokia's RAN strategy was built on its close partnership with NVIDIA, and that an entire Layer 1 RAN would be designed by Nokia to run on NVIDIA's CUDA software platform and GPUs. Layer 1 is the physical layer processing of the radio, so once the most basic part of the system is being shaped around one partner's software environment and hardware, the relationship stops looking like a simple component purchase. Here is the trade-off we can see clearly now. In October 2025, Nokia wanted faster 5G and 6G software on NVIDIA architecture, and by March 2026, that architecture was shaping the foundation of the product roadmap. Technical progress made that shift even harder to treat as optional. On March 1, 2026, Nokia said it had completed functional tests of AI and RAN workloads on NVIDIA's GPU-accelerated AI-RAN platform, and it also said tests with T-Mobile demonstrated concurrent AI and RAN processing on a single NVIDIA Grace Hopper 200 server. That matters in plain English because the same platform was being used for both network functions and AI tasks at once, which turned the partnership from a stated ambition into a working system. Pair that with the October 2025 statement that T-Mobile was already working with Nokia and NVIDIA on AI-RAN for 6G development, and the path from promise to practice becomes easy to track. Execution made reversal more expensive. We can see the point of no return in 2 layers. The first was ownership, because Nokia's January 29, 2026 full-year report confirmed that the share issue had been completed on November 13, 2025, and that NVIDIA had become an approximately 2.90% shareholder, which meant the company had changed its share count and its cap table rather than simply signing a technology agreement. The second was expectation. Reuters said Nokia's shares jumped nearly 21% on the announcement day and reached their highest level in almost a decade. So once investors priced the company around a specific strategic tie-up and the partner sat on the shareholder register, backing away became more costly even before the full technology outcome was known. The technical layer made that lock-in even stronger. By March 2026, Nokia had reported successful functional tests combining AI and RAN workloads on a single NVIDIA Grace Hopper 200 server, and T-Mobile had been part of that testing story from the start. In the same month, Light Reading reported that Nokia's Layer 1 RAN was being designed to run on CUDA and GPUs, which means the dependence had moved into core product design rather than staying off to the side as an experiment. That is the moment when an alliance turns into a path. It may still deliver results, but the easy alternatives begin to disappear. The larger lesson is not that Nokia made an irrational decision or wandered into the deal without a reason. The opposite is closer to the truth. In a year when it cut its profit outlook to Euro 1.6 billion to Euro 2.1 billion, absorbed a roughly Euro 230 million currency impact, faced another Euro 50 million to Euro 80 million from tariffs, and still generated Euro 2.4 billion of AI and cloud orders, the company chose money, speed, and credibility in one move. Its own annual report said the model was to focus innovation where Nokia differentiated and partner with best-of-breed leaders elsewhere, and in that setting, the NVIDIA transaction looked disciplined. The cost came later. That later cost sat in the structure of the choice itself. Once the best-of-breed partner also became a 2.90% shareholder, once the company's total share count rose to 5,742,239,696, and once the Layer 1 RAN roadmap began to run on that partner's software platform and GPUs, Nokia had less room to keep its future hardware options open. The deal still made sense at the time because it answered real financial pressure and tied Nokia to a powerful AI story just as the market rewarded that move. But the same decision that brought funding, momentum, and technical speed also narrowed the set of future choices. The decision was logical. The consequences were not. There are more decisions like this hiding in plain sight. Subscribe.